So yeah, I mean, the main story right now is escalations, right? We're seeing that we've been getting a lot of, just constant headlines with Iran and the US, US striking Iran, Iran striking the US. And what we can see is that overall, oil prices are still relatively stable, right? Right now, it's not really been pushing higher here. Brent is still relatively high. We can see that still pretty much at the 80 plus range, right? Topped out at 86, went back to 80, 83, and now WTI. We topped out at 80, now we're basically at 78. So, I mean, prices are elevated, right? We can see that structural shift there. It's pretty clear that we're sort of, we have shifted and we are now more or less bullish. We took out all the moving averages. We're holding the 20 moving average now. If we want to break below that, we'll see. But we already get the 20-day moving average sort of crossing that 200, which is not to say that it is a signal to buy. Obviously, I think to chase it up here is probably not a good idea. But two things can really happen here. We are creating that flag. Either we break above or we pull back to a more discounted level, right? Maybe at this resistance, and then we continue higher, or vice versa. Okay, you can also continue lower. So what are some of the things that will cause it to either go up or down? Well, more escalations, right? We've just been getting tons of news, just back and forth, back and forth, back and forth. And markets are just kind of holding it, right? They're not really reacting as of now because I would say it's already priced in. It's not a new concept, right? We've been getting this so often, and henceforth, that's why if we take a look at when the war first started, you can see how prices reacted immediately, right? And now it's a little bit more muted. At that time when the war first started, markets were uncertain. They didn't know how bad this could be. And so the oil prices just started to push up like crazy. But now more or less we have eased and we're getting that sort of pullback because there are escalations. The Strait of Hamas is disrupted. I wouldn't try to predict, right? But what I would say is that markets are slightly muted, yet it's still open to the potential of uncertainty, right? And that's pretty much mentioned across pretty much most banks, right? They are very aware of the upside risk, and they're also mentioning that there is a chance for more asymmetric risk. And what really that means is that if escalations continue, things get worse, then oil prices will likely move up fairly quickly compared to the other scenario. If it deteriorates, price will take time to gradually come back to normalization. It doesn't just happen overnight, right? Because it takes time to sort of pre-produce. Now, that's fine. However, you got to understand that that doesn't really necessarily reduce the situation fully, because at the end of the day, it can also backfire, right? Nobody wants to, let's say demand is slightly weak, have really serious effects from a cost perspective, right? Cost push inflation can really, really be a problem. So I don't think they're doing anything. Okay. So for that, because of that, reserves are dropping pretty much across the board for a lot of the main, countries that import oil. I believe euro is pretty much below the 5-year average in terms of their reserves. Japan, I mean, we've known that for quite a while now. That has also been the case. So yeah, I mean, look, it is a I wouldn't completely X out the potential for inflation to rise. Okay, now I know my thesis have changed quite a bit over I want to say a couple of weeks, but markets are shifting and moving the same way, right? Whatever that I'm saying isn't things that are just coming from me, right? These are things from the data to the information to institutional reports, right? But coming back to geopolitics side, right? So how is this going to affect markets? Well, let's take a look really quickly here at and what we can see is that price is still relatively solid. Okay, we have this pullback, we are at resistance. Why are we not pulling back even more, right? We had disinflation. Okay, we had core retail sales sort of drop. We have mixed data so far. I mean, we in terms of consumption and things like that, I believe those have still been relatively stable. But if we talk about mainly CPI, PPI, well, there's a clear easing in that cycle, right? We're not really accelerating, we're actually in this inflation. But why is the dollar not pulling back? Well, here's the thing, right? Initially, without the escalation, we were in possibly a environment that could have been very good for the markets, right? It could have been bearish for the dollar, great for gold, great for stocks, great for basically risk on assets. And bond prices would have shoot up, yields would obviously have fallen. I mean, that would be sort of the market that we were in. And to be very honest with you, that would have been a market that would have been great for continuation in a lot of these risk appetite currencies, right? Risk appetite would definitely be stronger. Now, regime-wise, we still think we are in a mild risk on, but why we say mild is because we still have that uncertainty risk caused by oil, caused by the Middle East, okay? So that's why the dollar has been sort of stabilizing. It hasn't been really pushing lower. Usually it would if we don't have any sort of overhead risk, but that's not the case right now. If we take a look at the 2-year yield as well, I mean we're still pretty strong, okay? I mean we are not really breaking lows, right? So markets are not really they don't have, they are more cautious in terms of risk on, right? They're not looking to really pile on non-yielding assets. They want to focus on yielding assets, and that's very, very apparent when it comes to a market that is uncertain, right? They want to be paid more for holding more risk. If you want them to buy, give them more money. I mean, give them, more earnings. That's essentially the point, right? To keep it simple. So that's the main point, right? And you might also ask, well, if markets are uncertain and we have geopolitical issues, why isn't gold actually rising? Isn't it a safe haven demand? Great question. That's not a wrong question at all, right? It's very, very the truth is, if it was in geopolitical issues, we are in geopolitical issues, but if let's say we didn't have any of the inflationary problems, then gold would have been a great buy. And it's, I'm not saying it's not a great buy either, right? But why is it not moving like it should when we have disinflation? Because the oil crisis, with higher oil prices, that's going to drive inflation. Inflation is going to drive a lot of the we can say inflation is going to drive a lot of the FX, okay? And that's going to create, for example, like the US, that's going to create higher yields, okay? Higher yields are going to potentially essentially give you more premium on what you invest in. So they would rather invest in a yielding asset like the bond market, right? They're basically getting 4+% a year, okay, to invest in something like that, and they would rather put their money in things like that, okay, where US dollar is more or less a safe haven. At the same time, you're also getting yields on what you're investing in on top of potential capital gains, right? So you're getting kind of the best of both worlds in an uncertain market, right? So it's just capital flow sort of shifting away from non-yielding assets. That's all it is, right? So if we take a look at stocks, right? Now I'm gonna try. Okay, you guys can see. That's good. So look at the stock market. So we do have some names, but look across the board for all the indices, we are not really doing very, very well, right? So risk on since yesterday, I would say, have been getting worse, right? Yesterday, I think half of these were red, and now we're pretty much getting about 80% of them red. Okay, look at metals as well, right? Look at commodities. What are the ones that are really pushing? So yeah, oil today is a little bit bearish, but pretty much look at the rest of everything else, right? Gold, I mean, it says up, but does it look like it's strong today? I mean, it's just literally holding at support. We take a look at WTI. We're up, right? We're holding the highs. We're not going down, breaking lows, right? So you can definitely see where the rotation of capital is, right? Now, if we take a look at the VIX, right? Because this is a very important chart to look at. We can see that compared to the beginning of the war, VIX is still relatively at lower ranges. Why? Well, like I said previously, the VIX is really sort of a risk on, risk off kind of idea, right? When we have risk on appetite, or we have risk appetite, usually VIX will be at the lows. When we have risk off appetite, usually usually the VIX would be at the higher range. Okay, so that's what we got initially because markets were uncertain. Now, more or less, markets have felt how bad it can be, and probably markets are not expecting it to be as bad as it was initially, right? Because they've already went through all of those headlines, they went through the ups and downs of Trump. They understand how he works and what he does, right? So risk overhead with some of the things that Trump said. They're not new to it, right? They've already experienced this. That's what this is, right? They've already experienced it. So therefore, I don't think markets are fully hedging VIX. That's why we're seeing a definitely pullback here, but we're not seeing structural highs break. All right. So markets are still, there's a bit of optimism yet cautiousness. Okay. So what's the plan? What do we do? Right? I would probably stay away from USD crosses, in my personal opinion. I don't think that's something that I want to be involved in. Currently, I'm actually in a long on the CAD UN. I kind of got in pretty much when a lot of the headlines started to really push oil prices a lot higher. If we take a look at the WTI just to compare the chart, right? You can kind of see I bought it pretty much right when there was, the speeches have been kind of happening around here, but then the second round I was able to get involved in that as well as WTI is moving. As you can see, it's moving very, very similarly, right? Yeah, the consolidation is right here, and you can also see the CAD is also kind of maintaining. It's not really doing very much, and you can see as well on the RSI that it's sort of stabilizing. It's not really continuing higher, so I do expect a pullback. I do expect the pullback. So what do I want to do? Well, I would like to buy into pullbacks, right? I'm not saying I'm 100% super confident in this. I have sold some, as you can see, I put an arrow there just to be sure. I sold 1/3 of the position. So I do want to see, I do feel like we're possibly going to get a pullback, and I do want to see if I can try to get a scale into this and continue towards potentially these highs here. Okay, so that's the plan. The pairs that I'm looking at that I think are worth watching. So euro, I mean, for right now, I think euro. Okay, so here's the thing, right? If we talk about some of the currencies that are gonna do better in this particular environment, right? With specifically on the Middle East front, CAD is gonna do probably better. US dollar is probably gonna do better as well. You can say that the potential other commodity currencies like the Australian could do well, but you gotta understand like, but so yeah, I would have a little bit more focus on all correlated assets like in the FX market. Now euro, however, I think they're going to be affected pretty badly. Why? Well, they're going to be affected with the inflationary side. They're low reserves. They're going to be paying premium, and at the same time, because they're massive importers, they're not really making money like Australia or Canada or the US, right? They're importing, so they're importing all the cost. So the inflation is going to come from the cost side. So cost push inflation, and then this could potentially also affect growth. So therefore, the euro has a lot of chances for potential continuation on the downside. And to be very honest with you, this is not a new concept. Actually, for the most part, macro backdrop hasn't been really that great. And markets have been positioning themselves pretty much shorting the euro for quite a while. And if we take a look at the positioning, we have been very, very bearish. Markets have been just shorting on the euro, and we've just been getting a lot of sales that we're getting a sort of mean reversion signal, which I personally feel, I think that's already kind of priced in, and I still think that there's a little bit more euro downside unless things shift, right? Now the thing is, your euro would have been a pretty good move, I think, if there wasn't any of these oil crises. If you take a look at any of the USD crosses, they've done extremely well. I've been calling this out in my prior videos before even the CPI results came out. I was already long GPB USD somewhere around the range here. I didn't hold all the way, but it would have been a phenomenal win. Kiwi as well, great move. Australian dollar, great move. Euro muted because, like I said, euro weakness isn't really bringing sort of that follow through. There's really no attractiveness there. And to be fair, I'm actually looking to short the euro, which I don't know if I'll get it. I've been looking at this around 15th of July, and what we can see is we tapped into this area of resistance, and then we kind of head lower. We're also at that 38.2, but I don't really like the short at 38.2. I would like actually prices to continue probably to the 61.8 because of how strong this move was. So I still think CAD has more strength, not because CAD is a stronger currency due to its macro backdrop. It's because of the current escalations, right, that will drive sentiment. So I think once this kind of blows over, the CAD will still be relatively weak. But for now, if oil prices go higher, that would be better for the CAD. It would be better for exports. It would be better for growth. But other than that, they're still weak right now in terms of growth. They're still weak in terms of jobs. So yeah, so this is strictly just a sentiment trade. Anything can happen. So we'll see. I mean, we'll just trade accordingly. We're not trying to guess everything correctly. But I still think that the escalation can continue for a little bit longer. But yeah, so Euro AUD. Okay, so the thing about Euro AUD we have to be aware of is that right now risk appetite has kind of fallen, so that would drop the Australian dollar a little bit. At the same time, China has been pretty weak in terms of its domestic growth, in terms of I think overall industrial production has been really good, but the rest of the other data sets have been pretty weak, especially on the consumer side. So that does bring growth a little bit lower. Um, and because of that, that does affect Australia because Australia exports about 30% of its goods to China, mainly I believe in commodities like iron ore and things like that. And if China consumption and overall, they're not really growing in that sense, that can create a little bit of weakness for the Australian dollar as well. But we do have to be clear that the industrial production side is still really good with in China, but it's obviously kind of a lot of the things that they're doing, they are building on their own for the most part, right? They're not really like importing too many things from Australia, but it does help Australia as well. So it's kind of mixed on the Australia front, but as you can see right now, Australia is slightly weaker because of the risk appetite drop, right? So markets are a little bit more on the uncertain, sort of cautious side. So this trade can not work as well, all right? It really depends. But if we start to get, I still think that from an interest rate differential, right, euro is still a lot lower. We're actually getting paid to go short on a euro AUD. We're getting paid short for quite a solid amount, right? I mean, I will try to get a so we paid about 0.195%. This is the interest rate differential. We're paid 0.195% to hold short, right? So this is still something I think overall has a good chance for continuation. So I will still look to short this, but I wouldn't say like I'm as confident to short this. If honestly, if we did get euro CAD, euro pound, I wouldn't mind actually taking those short instead. Okay, but for now, we'll see what happens. So risk appetite has definitely fallen just from a data standpoint. But yeah, so Euro AUD still prime, I think, overall. Like I said, just a little bit uncertain. I did have my pros and cons here. So we'll see, right? We'll see what happens. I will be a little bit more confident to take short around the 61.8 range where the 200 moving averages are. There's still a good chance we could take out those highs and maybe attack that VWAP area. And then we'll be at resistance, but I'll be a little bit more cautious. I probably won't stab at it short. I'll wait for prices to go lower and then maybe see if I can get some sort of continuation trade from that. What I do like about the Euro AUD front, okay, from a charts perspective, right? So this is strictly technical analysis at this point, is look at the daily. Beautiful bearish chart. We have all the moving averages sort of following what a bearish sentiment should look like, right? 200 moving average above price and above all the other lower shorter term moving averages. We can see as well that price tapped into the fib zone, and now essentially we can say that prices will probably hit lower. So the potential of reward is very, very high here. So yeah, Euro CAD, however, is a little bit tricky. Chart doesn't look that great. It's bullish, but it's also kind of very choppy as of recently. We can take a look at Euro pound is okay, daily wise, pretty clean. We can see how strong of a drop this has been. I mean, this would have been a great shot around these areas. Would have been just one of the best trades of the year probably. And I'll probably be targeting these weekly lows. So there's still a little bit of meat off the move, right? Wait for some sort of pullback to continue to that weekly demand area or support, whatever you want to call it, doesn't really matter. But that's a key level clearly on the chart. Why? Well, look, right? We have been at this level. If you take a look, realistically speaking, we have pretty much been a very long-term support level from 2016, guys. Okay, this is a very key area. We've tapped it once, twice, four, 5, 6, 7, 8 to 9. 9 times we've been sort of tapping at this level, so pretty strong. Okay. Yeah, so I mean those are the kind of plays that I have focused on right now. Other than that, really there's nothing else that really catches my interest now. To kind of focus more on the higher time frames, not to rush into the lower time frames. And kind of just focus on that and be aware of sort of the sentiment and the interest of the market right now, right? So inflation is there, all is there. I wouldn't say hawkish US dollar. I wouldn't say a hawkish Fed. I wouldn't say necessarily I would say rate cuts are pretty much off the table, but rate hikes are cautiously there. But I think for the year, I have a feeling that more or less they probably stay at the current rate. But some of the Fed committees have been speaking. I believe Logan, I don't know, some of the other members like Jefferson, etc., etc. Most of them were very, very hawkish. If inflation does come back, they'll likely have to change their policy, their monetary policy and how they want to actually approach this, which basically them saying rate hikes. Okay, but it's not a confirmation yet. So we'll see what happens. So therefore, I'm not saying that the US dollar has a ton of strength. I think for the most part, it's already been tired out. But if any claims of rate hikes from the Fed is going to drive this a lot higher, right? So right now there's no real catalyst, but I wouldn't say that the dollar is just going to drop. Okay, so what I would say is that relative strength in currency is probably the best play you can get, not really the US dollar idea that we used to have in mid of June where US dollar was hawkish, buy the dollar, short anything against that. Basically, that was sort of the idea, and that's all been tired out now. There's uncertainty in the regime, so therefore it's better to kind of just see what's of interest right now, and then try to trade other G8 currencies that kind of work with that, right? So not really just bet everything on the dollar type crosses.